Okay, good afternoon, finally. This has been another extremely busy day. Get my computer out of the way here. So that's why I'm starting this video at 4:19. So sorry to be starting so late and getting you your assignment so late. So anyway, I noticed that the few people that handed in their assignment had a lot of trouble with number 54. So I want to go over number 54, actually do number 54 completely right here. And then I want to just continue on in our section here on, or our chapter on finance, because that's going to be our next unit. And I think I'll announce this now, but I need to say more about it in a more formal way, I guess. But here is the news. So the date that seniors are to be done has already been announced. I'm not sure exactly what that date is. It might be like May 22nd or something like that. I'm not sure. But in any case, most of you are planning on taking this for this course for college credit. We will not be done by that time. It's just not going to happen. We have 2 more units to do, and we're just not going to be able to finish by May 22nd. So, for those of you who want the credit, actually, let's back up a little bit. For those of you who don't want the credit, you've decided, nah, I don't really care about the credit. Even though I'm 95% there, screw it. I don't want my free math credit. Notice how I'm selling this. If that's what you really want to do, and you just go, no, I'm not going to take my math credit, even though I'm almost done and I'm almost finished and I'm almost going to get my free math credit, then you can have whatever grade you get on May 22nd or whatever the grade is at that time. That's the grade you're going to get. And you won't get your math credit for Great Pay or any other place that you want to transfer your math credit to. But for those of you who are wise and want to continue on and finish up the course and get your math credit, your free college math credit that you can transfer to other schools, you're going to need to go past the time that other seniors might be done. I know that sounds frustrating and annoying. However, I think a free math credit, college math credit, is totally worth another week and a half or 2 weeks or whatever it's going to take for us to get ourselves done here. So hopefully all of you are going to decide to do that. And yeah, and hopefully you all listen to this lesson. Okay, so yeah, more about that on another time when I have more specific details from the principal and or the superintendent or somebody, but that's the scoop at the moment. So finding income tax and using simple interest formula. We'll do that second. We're going to do this income tax problem right now. So we're doing number 54 from the homework assignment. So we have an unmarried head of household with 1 dependent child. Their gross income is $40,000. Remember, gross income is just the amount of money that they get, no taxes taken out, nothing taken out, just this is the money they made. It's the money that came in. Their weekly salary times 50 weeks or whatever. They have adjustments of $1,500. Remember, adjustments are, things like health insurance or other things, other monies that come out before the tax calculations are really begun. And then deductions, we have $3,600 in state taxes, and we have $800 in charitable donations. And there's a tax credit of $2,500. Again, the tax credit could be that, overpaid by $2,500 last year, or, some other thing, like I said before last time, maybe bought some high efficiency windows and installed them in the house, super energy efficient windows, and you get a tax credit for that, or, lots of different ways to get a tax credit. Okay, so here's the deal. So our adjusted gross income is going to be the gross income minus the adjustments. So that's easy enough. So we got $40,000 minus $1,500 is $38,500. So we got 40,000. Let's put this up here. 40,000 minus 1,500. Yep, 1,500 equals $38,500. So that's the adjusted gross income. But we're not quite done yet. We need to figure out our taxable income. Well, taxable income is the adjusted gross income minus the exemptions and deductions. So remember, our deductions are up here, and the exemptions are, from the chart that we have anyway, the amount of money that you're allowed to take for yourself or any dependents. So in this case, that's $3,500 because that's what it says right in the chart that is on whatever page it is. So that's $3,500 for you and for any dependent person, whether it be a child or you have to care for a parent or whatever. So that's going to be adjusted gross income is $38,500 minus, so the exemptions are $3,500 times 2, because there are 2 people, this person and their child. So that's $3,500 times 2 plus the deductions. Okay, now this is where things get a little bit tricky here. So if we add up these 2 deductions here that they have, $3,600 in state taxes and $800 in charitable donations, that comes out to be $4,400. But as it turns out, again, going back to our chart, I'm not going to like haul up the book right here, but trust me, going back to our chart, it says that we will take for deductions if you are an unmarried person, head of household, and you have dependents, you are allowed $8,000 in deductions. And you should take the larger of the 2. So either $3,600 plus $800 makes $4,400 or $8,000, whichever one's bigger. So, I mean, you can take $4,400 if you want, but the government allows you, again, in this particular year, back in the day, it's a little different now, they allowed $8,000 for unmarried head of household. So that's going to mean for us, we got $38,500 minus $7,000 plus $8,000 is $15,000. So that's going to mean we have $23,500. So our taxable income is $23,500, which is actually pretty good because we started off with $40,000 and now we're only going to be taxed on that much right there. So a whole bunch of money we're not even going to be taxed on. Okay, so let's continue our calculations here. And so the tax is going to be the tax calculation, which we're going to do right here, minus the tax credit. And remember, we had a $2,500 tax credit, so we need to make sure we don't forget that. Okay, so, one more check here, $23,500. So we have $23,500. I just want to put this over here so I don't forget it. So that's how much we're going to be taxed on. So we're going to pay 10% on anything up to the first $11,450. Well, 10% of that is going to be $1,145. So that equals $1,145. Right? Just move the decimal place once. Okay. And then we're going to pay 15% on anything over $11,450 and below $23,500. So basically, we're going to pay 15% on the money that is the difference between these 2 guys here. So we're going to do 0.15 times 23,500 minus 11,450. 11450. And calculator's downstairs, so we'll just use my phone right here. And blast through my little calendar reminders here. So we're doing 23,500 minus 11,450, 11450 equals, take 15% of that, equals 180750. Equals 180750. Okay, so we got to pay this and this. So we're going to add those 2 things together. So I'm hoping I can do that in my head. 5, 0. 7 and 5 is 12. Carry the 1. 4 and 0 and 1 is 5. 8 and 1 is 9. And 1 and 29, 5, $2,952.50. I just want to make sure I'm correct with that. 2, 1, 5, good. Yep, there it is. Okay. But again, remember we have a tax credit of $2,500, so we're going to subtract $2,500 here. that's going to mean we have to pay this much tax. 2, 5, 4. $452.50. So here's what happens. So let's say that we paid, I don't know, let's say $2,000 in taxes throughout the year. Well, then we're going to get back a whole lot of money because this is all we were supposed to pay, and we paid too much. $2,000 minus $452.50. That's how much we'd get back in taxes. And let's just say instead we paid $100 in taxes. Well, we were supposed to pay this much throughout the year. So now we owe $452.50 minus 100, or $352.50. So it just depends upon whether you're going to get a refund check or you're going to have to pay more taxes at the end of the year, April 15th-ish. Okay, so there's problem number, whatever that was, 56 or 54, or whatever it is, 54. Okay, so simple interest. So interest is money that either you make on an investment or a bank makes on interest in a loan. So we don't actually really use simple interest because we use more complicated calculations, but we're going to kind of introduce that concept through simple interest, and then when it comes to the more complicated stuff, compound interest, then it'll be easier to understand because we will have already understood it through this simple interest formula. So it's really simple. So simple interest is I for interest equal P, or the principal, the amount that we are investing, or the amount that we're borrowing. It's that big chunk of money. R stands for the rate, and of course it's the interest rate in a percent, but we change it into a decimal. T is time, and we want to say that this is in years. And that's an important distinction here. Okay, so first problem. Bob took out a loan for $4,800. Should have put a dollar sign there. $4,800 for 12 years at 4% interest. What is the interest on the loan? Simple. So we do I equals $4,800. That's how much he borrowed. That's the principal. Times the interest rate. Well, that's 4%. Change that into a decimal, 0.04. And then we do that for 12 years. So that's times 12. And so we got 4,800 times 0.04 times 12 equals 2304. 2304.00. So that's actually quite a lot of interest, really. But, you know, that's what happens when you pay interest for 12 years. You pay a lot of interest. Okay, so there it is, your first simple interest problem. Easy stuff. All right. So future value. So future value really means the amount that we're going to have at the end of something. Again, either an investment or a loan. So here we go. So Bob takes out a short-term loan for 6 months. That's important. He borrows $1,000 at 8.4% interest. So how much is he going to end up having to pay all totaled? So kind of what's the future total value of all that he paid? So that's what we're doing right here. So this is our future value formula. Amount at the end equals the principal times 1 plus rate times time, just like we had before. So again, simple stuff. So principal, so we got $1,000 because that's how much Bob borrowed. 1 plus the interest rate is 8.4%, so we do 0.084 times, now it says 6 months. Well, this time here is supposed to be in years, and we know, of course, that 6 months is half a year. So we don't put 6 there, we put half a year. So we just do the calculations again. So we do 0.084 times 0.5 equals 0.042 plus 1 equals 1.042 times 1,000. And we got $1,042. 1,042. So Bob's going to take out a short-term loan for 6 months. He borrows that at 8.4% interest. So at the end, he's going to end up having to pay $1,042. And so you're thinking, well, who would do that? well, maybe Bob needs $1,000 right now, and he can't do without it. Like, I don't know, he has to have surgery or something like that, or he needs $1,000 to fix his car, and if he can't fix his car, then he can't get to work. So he needs the money right now, and so he takes out a short-term loan and ends up having to pay some interest for the convenience of someone saying, sure, we'll be happy to give you $1,000. You're just going to have to give us $42 back in addition to the $1,000 later. So that's how banks make money. It's also how loan sharks make money, by the way. All right, so here's the next situation here. So Bob is going to borrow $4,500, and he's going to pay back $5,000 after 18 months. So what was the interest rate? So in the previous problems, we've been given an interest rate. This time we got to figure it out. But we still got the same formula. So we got A equals P times 1 plus RT. And we know that the amount at the end that Bob is paying back, the total value of all he paid, the future value of all that he pays is $5,000. And we know that he started, or he borrowed, $4,500. We don't know the rate. However, we do know the time, and the time is 18 months, aka 1.5 years. So we're going to have to do a little algebra here, and that's cool, because who doesn't like algebra? So 5,000 equals 4,500 times this, so that's obviously 4,500. And then we got 4,500 times 1.5, and it's been a long day, so I'm not going to trust my brain right now. 6750 R plus 6750 R. So now we're going to subtract $4,500 from here, so that's going to give us 500 equals 6750R. Now divide both sides by 6750, so we get 500 divided by 6750, and we end up with 0.074. So R equals 0.074, aka 7.4% interest. So it's all pretty simple, right? This formula is pretty simple. It's not called simple interest because it's a simple formula. It's called simple interest because it's not compound interest. Well, and again, we'll talk about compound interest next time. Okay, so here it is. Bob wants to have $3,000. This is Bob the builder, by the way. Bob wants to have $3,000 for a new tool shed in 2 years. How much money does he need to invest at 5% now to have that needed cash? So again, we're going to use that same formula, amount at the end, principal at the beginning, 1 plus RT, and just fill in the stuff. So we know that he wants to have 3 G's at the end, so $3,000 at the end of time, and we got 1 plus interest rate is 0.05, I should write 0.05, times the amount of time, which is 2 years, times 2. So that's going to be $3,000 equals P. Well, 0.05 times 2 is 0.1, so that's going to be 1.1. So if we want to find P, we just divide 3,000 divided by 1.1. And let's figure out what that is. So 3,000. Blast through my calendar reminders again. 3,000 divided by 1.1 equals 272727 forever. So 2727.27. So he needs to invest $2,727.27 now so that he'll have $3,000 in 2 years at 5% interest. Okay, there it is. There's the short lesson. Well, actually it's 19 minutes. So anyway, sorry to be so late, and I'll see you guys on Wednesday. Be safe.